Are you tired of overpaying for your gold, silver, and platinum bullion coins and bars? Then visit sdbullion.com today. SD Bullion was recently named the 177th fastest growing company in the United States by Inc. magazine. This is because they offer the absolute lowest prices in the industry and follow up with over-the-top customer service. So what are you waiting for? Go to sdbullion.com today and join more than 60,000 happy investors that save money on every precious metals purchase they make.
Hey everyone, this is Elijah Johnson with silverdoctors.com, and back with us today is Michael Pento from Pento Portfolio Strategies, and co-hosting with me today is James Anderson from SD Bullion. Michael, thank you so much for joining us today for this week's SD Metals and Markets Wrap.
Great to be back on.
All right, now the first topic we were going to discuss with you is the Fed's hawkish policies right now. You've been saying that really it's one of the most hawkish times in Fed history, with them raising interest rates, with them pulling back from QE and actually doing kind of reverse QE. They're tightening and selling back mortgage-backed securities. And you say with the dollar rising, we're seeing just foreign markets in turmoil, especially the emerging markets. Can you expand on all this and what effect this is having?
Well, the Fed raised 7 times, and they're going about now at a pace of 4 times per annum, so 25 basis points, about 100 basis points a year, which is 1%, which, you say, well, that's not the most tightening I've ever seen from a Federal Reserve in the history of the Fed since 1913. But wait a second. When you throw in QE, quantitative easing in reverse, also known as quantitative tightening, that is at a pace come October of 50 billion per month or 600 billion per year. So when you add 100 basis points of rate hikes per annum, 7 already in the hopper, and when you add in 600 billion of the dumping of their balance sheet, you have a very aggressive Fed in my opinion. And what I find very interesting is I did a little work on the balance sheet reduction. So people might say, well, Mr. Pento, don't you remember Paul Volcker when he was raising rates to 20% in the Fed funds rate? He took rates from 10% to 20% in his tenure from when beginning in 1979 to when he stopped in 81. But when you look at the reduction of the Fed's balance sheet back then, the percentage reduction, it's pretty much the same as the reduction in the Fed's balance sheet, which is occurring right now. So in my estimation, in the way I look at things, the way I look at the data, this is perhaps the most aggressive tightening of a central bank, raising Fed funds rate and destroying money. Don't forget, when they sell their balance sheet down, the Treasury has to issue bonds to the public. So the public has to absorb this debt, $600 billion a year, and that $600 billion gets burned and destroyed by the Federal Reserve. That money is wiped out. So it's a very aggressive Fed, and the Fed is tightening, in my opinion, into an economy that's not really runaway crazy growth. We're growing at we were growing a little bit over 2% under the Obama years. We're growing perhaps at 2.8% per annum under the Trump years, and it's really not a situation where you have rampant money supply growth and runaway GDP growth. So they're tightening very aggressively into an economy that is just not all that strong.
Hey, Michael, when you say they're tightening is akin to the late 70s with Volcker, are you talking about it in terms of percentage terms on the balance sheets?
Yeah, that's exactly what I said. So if you look at the reduction, my work shows that the balance sheet under Volcker decreased by about 14%, and that's pretty much where you are going to be with the Fed's reverse QE. So when you add that balance sheet reduction with the tightening on the Fed funds rate, raising the cost of borrowing in this very over-leveraged economy, I will hasten to add that the economy wasn't anywhere near as leveraged under Paul Volcker as it is today. I mean, we have record national debt to GDP, which is 105%. It's only been eclipsed a very small amount of time right after World War II. If you look at corporate debt as a percentage of GDP at 46%, it has never been higher, even as a percentage of the economy. Nominal, it's off the charts. And even household debt is at a nominal high, although not as a percentage of income or GDP. So you never had such an aggressive Fed on top of record debt and record asset prices. I also hasten to add that asset prices weren't at a record in 1979 and 1980. Today, asset prices, so if you look at household net worth, which is primarily stocks and real estate as a percentage of the economy, has never been higher. It's way, well, not way over, but slightly over 500% of GDP. It's normally just about 300% of GDP. And of course, total market cap to GDP is at a record high. So you have record asset prices, you've got a record amount of debt, a record amount of corporate debt. Corporate debt is the structure of that debt has never been, the quality of that debt has never been lower. And you have a Fed that, in my opinion, has never been more aggressive. That's a pretty dangerous cocktail.
Yeah. One other point you just mentioned about record global debts. I think the IIF a couple of days ago came out and they stated it's around 249 trillion now as of Q1 2018. So we're almost at 250 trillion, a quarter quadrillion in debts. And we just went over a couple of the differences. One other was the fact that emerging markets obviously took on a lot of US dollar debt in the last decade or so. So that's obviously throwing in a little bit of a curveball here as well. That's maybe perhaps one thing we could discuss. Yeah.
So my figures, I used the McKinsey report has total debt at 270 trillion. It's about 330% of GDP, has never been higher, up some 70 trillion from 2007. You mentioned emerging market debt. Emerging market dollar-denominated debt is around $11 trillion. So, I mean, you have a surge in borrowing from emerging markets, dollar-based. Look at Argentina with their 100-year bond that's backed in dollars. So, you look at people who are so hungry for yield, they're willing to give a serial defaulter like Argentina a 100-year bond, which I'm quite sure, and they already went to the IMF for a bailout. That bond will be defaulted on for sure between now and the next century. Yeah, much sooner than 100 years.
One thing to bring up too is the dollar strengthening, right? We've seen a lot of dollar strengthening, and that's probably causing a lot of tension right now, and perhaps even in the trade war that's going on with China and the U.S. What are you seeing in that regard?
Well, you had, like I said, $11 trillion of borrowing in emerging markets, and there's a bear market in emerging markets around the world. Shanghai was down in a bear market over 20%. You look at Poland or Argentina, Brazil. There's distress around the world. So, as I'm sure you know, if you have a dollar-based loan and your country is in Argentina has pesos or whatever your domestic currency you're using, it's a lot more difficult to pay back that debt. It increases the debt burden as the dollar rises. And why wouldn't the dollar rise? I mean, here you have a guy who's an Austrian economist. You have a guy here who considers himself a gold bug. I think gold is fantastic. It's the only real form of money that God gave us, really. And then you say to yourself, well, what's going on with gold lately? Why isn't gold reacting well? Well, if you look at the dollar is rising because of interest rate differentials. You have a Federal Reserve that we just talked about could be the most aggressive Fed in the history of our central bank. And then you look at growth differentials. We're growing here, in the mid to high twos in the United States. And you look around the world, I mean, Japan is halfway into a recession, and their central bank is going QE, pedal to the metal, not even talking about raising interest rates. And the ECB, the European Central Bank, might reduce their QE in October to 15 billion euros per month, going down to zero at the end of December. But they vowed not to raise rates, not even to think about raising rates until at least the summer of 2019. So, you have the Fed way over his skis, very aggressive. The dollar is rising. And also, when you have trade wars and you have a turmoil in the global economy, people tend to flock to the dollar for safety and into our bond market. So, yes. So if you have a trenchant gap between interest rate differentials and a trenchant gap in growth, then the dollar would stand to benefit.
No, you've talked about in our last interview and also in interviews after that with other people, especially on usawatchdog.com. You were recently on there, and you were talking about how you see a collapse coming later this year, possibly in October, for the U.S. economy. What do you think? Well, first of all, can you expand on that and maybe give us an update on how we're still progressing towards that? And then also, what is your perspective on how this will impact the gold market? Because last time in 2008, when we saw a collapse, gold took a big dive. So what do you think will happen to gold?
Okay, so there's a confluence of events that really come to a head in the fall. So, I mean, I hope I can remember them all, but I'll give you just a few of them. Well, first of all, number one is, I'm going to be 55, so I can't remember everything, but I'll tell you this. So, number one, the yield curve will probably invert with the next rate hike. So right now, the spread between the 2 and 10-year note, which is the yield curve, is down to 25 basis points as of this morning. 25 basis points. So if the spread between the 2-year note and the Fed funds rate remains constant, then the next rate hike in September, which is virtually guaranteed to occur, is going to completely flatten out that 2-10 spread. And then if they go again in December, which I believe they will, unless the economy and the stock market fall apart by then, who knows, but only God knows. But if it does not occur by that time, then you're going to completely invert the yield curve. So you have that, and by the way, when the yield curve inverts, it's indicative of a recession coming very quickly, usually about 18 months, 12 to 18 months out. But I believe it's going to happen a lot sooner, because normally when the Fed is raising interest rates, it's trying to catch up with inflation that's running intractable. That's not the case right now. So you have the Fed's going to invert the yield curve, and then you still have $50 billion per month of money destruction from their quantitative tightening program. So, I mean, I believe, that's going to cause a recession to happen much sooner. Of course, you have the huge credit impulse from China now behind us. So that's another reason why I think things are going to become particularly salient in the fall. There's a good chance, unfortunately, that conservatives in the House of Representatives could lose the White House in the November elections. So that's another issue. The ECB goes from 30 billion to 50 billion euros. And that means that the amount of quantitative easing, which at one point for a stretch in 2016, 2017, on a monthly basis and on a global net basis, was $180 billion of quantitative counterfeiting each and every month. That in October goes to zero. Here's a couple more things that I managed to remember in my old brain. Is that the big stimulus, the tax cut stimulus, goes away. So you have earnings growth, which has been propelled into the mid 20% range because of this one-time deficit-fueled tax cut. That's going to roll over. So the comparisons between Q1 19 and Q1 2018 are going to be very, very difficult, extremely difficult. And that's going to be priced into the market usually about 6 months in advance. So that's another reason why the fall will be particular strident time. And lastly, the big impetus from corporate buyback. So you had corporate debt, as I mentioned, as a percentage of GDP, has never been higher. Corporations issue debt for what? To buy back shares. Well, you have interest rates that are now rising. LIBOR is up to 2.33% from pretty much almost zero. It was 0.3% not too long ago. So it's costing corporations a lot more to borrow money to buy back their shares. The tax cuts, that stimulus is going to wear off by 2019. And the repatriation of foreign earnings is going to wear off. So the big stimulus for corporations to borrow money and to repatriate earnings to buy back stocks, which is happening right now like it's never happened before, that all goes away in 2019. So you could have a recession, an inverted yield curve, no more corporate buybacks, Republicans lose the House. I mean, there's a confluence of events that makes me very, very nervous for the fall. And when you add it all up to the fact, well, why are you so nervous in the first place? I'm not just a Cassandra. I'm saying that when you have the Great Recession of 2008 was a debt issue. People had just too much debt. Banks had too much debt. Everybody had too much debt, mostly household debt. But then it was bailed out by making the public sector insolvent and by making corporations, many corporations, especially corporations that have to issue junk bonds, insolvent. And that's why when you have record asset prices sitting on top of record debt, the worst thing that can happen is a dramatic slowdown in the economy. I predict one coming in the fall. And boy, it's going to, if you're not prepared, I own an active managed strategy. If you're not prepared and understand and be able to model and protect yourself from this, you very easily, hasten to mention that the last two recessions, the stock market lost 50% of your value. And it could get a lot worse this time because the simple fact is central banks don't have the bullets that they once had. Like I like to mention, what if Japan goes into a recession now? What is Mr. Kuroda going to do? The head of the central bank there. What is he going to do? Is he going to lower interest rates? Could he print more money? I don't think that's even possible to counterfeit more money at the monthly pace that they're doing. The ECB could go back into quantitative easing, but they certainly can't lower interest rates. And even our Federal Reserve, we're much better off in a better position. But all we could take back is, in my opinion, the 250 basis points that we will have at that time, say by the end of the year. 250 basis points is all we have. Usually takes over 500 basis points to lower the borrowing costs to save an economy and pull it out of a recession. So then one more thing, balance sheets are strained across the globe. So the public sector balance sheets, like we had this big TARP program, $800 billion. We're going to have deficits. I want to let you get a question in here because I know you probably get one. But we could have deficits that approach $4 trillion per annum if we have a recession. Is that really the time that you're going to have a massive stimulus package passed by Congress? I don't think so. So there's just not a lot of wiggle room. That's the big problem here. Once we have this recession, what can the government and central banks do about it? And let me just see if I can run through the numbers on that $4 trillion. So, I didn't just pull it out of the air. So you have $1.2 trillion baseline deficit in fiscal 2019. You got the $600 billion of reverse QE. You've got the diminished appetite for treasuries from China. They own $1.2 trillion in currency reserves, which they could threaten to dump if the tariffs hit very hard. They can only raise tariffs to the amount of U.S. imports from China, which are about 200 billion. But beyond that, they can threaten to reduce their value of their currency or sell their treasuries. So I don't know, are we up to about 3 trillion there? And then if you have a recession, the slowdown in revenue usually raises the deficit by $1 trillion. So if you have a $4 trillion, circa $4 trillion annual deficit, which would be about 16% of GDP, I don't think you're going to be able to pass a massive, a stimulus program.
Right. Yeah, I mean, it's the psychological effects of trying to do that too might break people, and all of a sudden you might get unintended consequences that you never thought were possible.
Well, you might have I wrote a book called The Coming Bond Market Collapse, and you could imagine what would happen if you had the Fed and the rest of the world go back into QE. They engage in this universal basic income scheme, which I think is coming. It's being tried all around the world, so it's coming. Paying people to stay home and drink and smoke cigarettes, basically being non-productive. And then you have helicopter money, UBI, negative interest rates. I don't think that's really good for the faith in fiat currencies, and certainly not going to be good for the bond market. Anything that's not being actively purchased by central banks, any kind of fixed income that's not being actively, and even if it is actively being managed by a central bank, it would just implode in price and the yield would go skyrocketing. So there's a lot of issues, there's a lot of issues coming down the pike that need to be dealt with by someone who has a good foundation in economics and in markets. Because if you're just like a buy and hold, everything is going to be kosher, let's just buy and hold and dollar cost average into stocks when they're at a record high, and we're on the precipice of a major worldwide recession / depression, with not much governments and central banks can do about it, you might have a problem.
Yeah.
You're going to have a problem.
Yeah. Well, we're short on time, Michael, but real quick, what is your perspective on
gold? I'm sorry, you said you were going to ask me about gold.
Yeah,
right?
what is your perspective on how the coming collapse will impact gold?
So gold, what gold loves, what the gold environment loves, is falling real interest rates and a weakening dollar. If you're buying dollar, if you're pricing your dollar in gold, that's the cross you're using, pricing your gold in dollars. So when the Fed goes back, let's back up. When the economy slows down, when that becomes manifest even to the automatons on CNBC, when that becomes manifest even to them, they can see it, and even to our Federal Reserve, when they stop raising interest rates, that's not going to be enough. When they stop draining the balance sheet, that's not going to be enough. When they go back into QE and they're able to get the dollar to fall and to get real interest rates to fall, when they're able to get inflation, that's when gold is going to skyrocket. Now, gold's not going to wait for that to happen. It'll anticipate that happening. So my best guess, I have a model. I look at prices. I look at the indicators. My best guess now is sometime in the fall, October, November, December. That's the time frame I think you're going to see a big, massive watershed turn, a bull market turn in the gold market. But stay tuned. You never know. You never know what's going to happen. But certainly, when one of the ramifications that are it's virtually assured to happen, is that the faith in fiat currencies is going to be obliterated. And that's what brings about inflation. Inflation doesn't come from people working. It comes from people losing faith in the purchasing power of their particular fiat currency. And I think that's going to happen on a global scale against gold. And it's going to happen soon. And that means you want to be buying some gold when it's on sale.
All right. Well, Michael Pento, thank you so much for your time today. Before we let you go, did you want to share with the viewers where they can find you and any last thoughts you had?
Well, you can reach me you can email me at mpento@pentoport.com. The office number here is 732-772-9500. And the website is pentoport.com. I just want to stress, I think I'm here for a reason. I think God puts everybody here on earth for a reason. I think one of the reasons why I'm here is to help people navigate through this coming tumult, which is going to be worse than, I believe, and worse than anything we've ever seen before on a global macroeconomic scale. And it's going to be very necessary to have someone here to help you preserve and protect your wealth.
All right. Once again, Michael Pento, thank you so much for your time.
Thank you.